If you want to make $100,000, $1 million, $100 million, anybody can do it. Welcome to Real Estate Market Moves. Today we're going to talk about the 2024 housing forecast that just came out by Realtor.com, National Association of Realtors. Let's take a look at what they are seeing for the 2024 housing market. Right now, they're saying that housing affordability finally begins to turn around because prices are dropping in some areas and interest rates are coming back down from the peak of 8% that we saw earlier in the month, October, November, rates peaked at 8%. But as we look forward, this is Realtor.com, National Association of Realtors forecast. As we look ahead to 2024, they see a mix of continuity and change in both the housing market and the economy against a backdrop of modest economic growth, slightly higher unemployment, and easing inflation. Longer-term interest rates, mortgage rates begin to slow and retreat. The shift from climbing to falling mortgage rates improves housing affordability, but saps some urgency from shoppers. But saps some of the urgency home shoppers had previously sensed. Less frenzied housing demand and plenty of rental home options to keep sales relatively stable at low levels in 2024, helping home prices to adjust slightly lower even as the number for sale homes continues to dwindle. So inventory levels are still down, even though rates are dropping. The debate and conversation is if rates continue to drop, that will open up demand and increase inventory, which will bring house prices down. Unfortunately, I don't agree with that. I think as rates drop with as little inventory as we have out there in general, of course, every market's different. We're talking, just in general, every market's different, but on average, most markets are still constrained, very little inventory to speak of. If rates come down, that's going to put pressure because there is pent-up demand out there. We're going to see bidding wars again. I don't think that's going to automatically create spontaneity for people to put their houses on the market. The thinking is as rates drop, people that are locked into low mortgage rates will put their houses on the market because now they can get a lower rate somewhere else. But again, most people are locked into rates below 4%. We're still at 7%. That is not enticing enough for somebody to put their house on the market. And if it was, there's nothing out there for people to buy. So that is not going to solve the problem. It's going to take higher rates much longer to really correct the housing market. You need more distress. You need more forced selling. You need sellers that have to sell their houses for whatever reason. And you need more inventory to come on from builders because a lot of that inventory is getting consumed for rental units. But the forecast is mortgage rates at 6.8%, on average 6.5% by year end. Existing home median price down 1.7%. Existing home sales up 0.1%. Existing home for sale inventory down 14%. Single family housing starts up 0.4%. Home ownership rates up 65.8%. Rent growth down 0.2%. So these are forecasts for 2024. Really doesn't mean a whole lot of anything because they haven't been right so far in terms of rate forecast or affordability forecast, things like that. Home prices dip a little bit, improving affordability, but again, prices are still up. So let's take a look at this chart right here. This is the price, median home price going back all the way to 2012. You can see the upward trend. Even though prices have come back a little bit, and you're seeing 20, 30, 10, 20, 30% price reductions on some houses in some markets, that is because the prices were distorted, extraordinarily high, very distorted levels of pricing. So even though they've come back, we're still well above pre-pandemic highs. So the pandemic was 2020. So if you look at where the pricing was pre-pandemic, you're talking about $250,000, even $300,000 September of 2020 after the pandemic started. So this is your where the boom started in housing, coming off of that pre-pandemic level of January of 2020 in the 200,000 range up into the 300,000 range, and it's continued to climb. So median house price is still well above pre-pandemic levels. Again, 10 years of appreciation over 2 years is what we've seen in the housing market going into the third year now. It's going to take time for that to unwind. With the lack of inventory, that's not going to help home prices anytime soon. And with rates, even with rates coming down, that's going to increase some demand as we saw refinance applications and refinances pop on the interest rate drop because consumers are under pressure. They have to refinance to pull equity out of their house. But new purchase applications for mortgages were down, transactions are down, prices are down, things like that. Home sales are expected to remain steady with a little bit of growth. Even though things are still slow, there's still 4 million houses selling right now. Typically, you see around 5 million to 6 million at the peak in 2021, but around 4.5 to 5 million homes. That's dropped down to 4 million. And the key is inventory. Inventory is still below 1 million, right at 1 million, when typically you see 2 to 2.5 million homes on the market at any given time. With 6 months of supply on the market, we have less than 30 days of supply on the market right now. Sustained improvement in inflation is expected to bring mortgage rates down to 6.5% by the end of 2024. That's based on the 10-year Treasury yield and the Fed funds rate. The markets have multiple rate cuts forecasted for 2024. We will see if that's the case. The markets are expecting the Fed to cut rates. So we'll have to see if that holds through and holds true. The commercial real estate market is continuing to experience distress, even though the 10-year has come down. So some commercial mortgage rates have come down, residential mortgage rates have come down. The Fed funds rate is still elevated. So that's keeping pressure on rates. Corporate debt that has to be refinanced, even if the Fed funds rate and mortgage rates and interest rates come down 1%, that's still way higher than where they were because they were at 0 to 2%. So now they're in the 6s and 7% range that they have to refinance corporate debt, commercial debt, things like that. So that's putting a lot of stress on the industry, a lot of stress on commercial real estate assets. Multifamily for the first time is coming under pressure. That's typically been the most resilient sector of the market. Self-storage is coming under pressure. That's been one of the most recession-resistant areas of real estate to be in. And again, it's inventory. So there's more supply has come to the market in the last number of years in self-storage and commercial, multifamily real estate. So that's putting more housing units on the market for rent, which is putting pressure on rents, putting pressure on value. So still a lot of stuff to work through. 2024 is going to be an interesting year. We're going to really see where the economy stands when we get Q4 numbers of 2023 and Q1 numbers of 2024. I think we're going to really know where the economy and the consumer stands in 2024 when all of the bills come due from the revenge trade coming out of the pandemic, the doom spending that we're experiencing in the fall and into the holidays this year. Consumers are still spending. Retail sales are up right now. The holidays are upon us. So consumers are still spending strong and holding strong. Prices are still up in a lot of areas of goods and services that we consume every day, although oil prices are down, which means gas prices are down. So hopefully that will continue to stay down, which is helping fuel holiday spending. So these are the things I'm looking at. I'll see you on the next video.